Hi, thank you for watching Digging to China. I'm Dong Shang. Chinese firms have raised money from US shareholders for years, but their auditors violate a fundamental investor protection because China typically won't allow American regulators to check their work. Chinese companies including Luckin Coffee Inc. have imploded in accounting scandals over the past decade, raising awareness of the audit-inspection gap. In the US, audit supervision is handled by a special watchdog, the Public Company Accounting Oversight Board, aka PCAOB. It was set up after the accounting scandals that took down Enron Corp and others nearly 20 years ago. The SEC oversees the PCAOB and appoints its board members. Most foreign companies already comply with US auditors. However, Chinese law prevents audit papers from leaving China, meaning US regulators cannot easily verify their quality and identify potential risks for investors. Chinese authorities have long been reluctant to allow overseas regulators to inspect local accounting firms, including member firms of the Big Four international accounting networks. Why? National security concerns. In 2013, an agreement between US and the Chinese auditing authorities was signed. It was intended to streamline a process allowing an SEC auditing watchdog to access audit documents of Chinese companies listed on US markets. The deal was initially welcomed as a breakthrough for financial transparency. However, US officials say China has not allowed access to audits. In August, William Dunk, chairman of PCAOB, said the board has no prospect of being able to oversee disclosures and prevent accounting fraud in China. In 2018, the US Securities and Exchange Commission and the Public Company Accounting Oversight Board issued a warning to investors about the difficulties US regulators faced in inspecting the audit work and the practices of accounting firms in China that examine US-listed Chinese companies. In 2019, two bipartisan bills were introduced aimed at going after Chinese companies that don't comply with auditing rules in the US. Van Hollen's bill, which was co-sponsored by Senator John Kennedy and introduced in March, gives listed Chinese firms 3 years to come in compliance with oversight requirements of the PCAOB in an effort to restore reporting credibility. A similar bill was introduced in June, sponsored by Senator Marco Rubio and the Democratic senators. This bill subjects US-listed Chinese companies to the regulatory oversight that includes turning over its audits or face delisting. Republican Senator Marco Rubio said this in a statement, quote, "Beijing should no longer be allowed to shield US-listed Chinese companies from complying with American laws and the regulations for financial transparency and accountability," unquote. Democratic Senator Bob Menendez, who joined in sponsoring the bill, also said, quote, "It's time for China's government to play by the same rules as American companies in our financial markets," unquote. Van Hollen's bill, the Holding Foreign Companies Accountable Act, HCAA, passed the Senate in May. A week ago, on December 2nd, the House unanimously approved this legislation and it could quickly become law with President Trump's signature. Senator Chris Van Hollen and the Republican Senator John Kennedy said in a statement that US investors have been cheated out of their money after investing in seemingly legitimate Chinese companies that are not held to the same standards as other publicly listed companies. One case involved a Chinese coffee company, Luckin Coffee, which built up massive investment capital in the US, touted as the future Starbucks of China, before it admitted to fabricating $300 million in revenue in 2019 and was subsequently delisted from NASDAQ at a heavy loss to investors. Under the measure, Chinese companies and their auditors would have 3 years to comply with inspections before a trading prohibition could take effect. If a breakthrough looked unlikely, the companies would probably respond ahead of a ban by either going private or moving their listing to a non-US exchange. House lawmakers included a statement that clarifies the bill's intent. The instructions don't have the force of law but direct the SEC to implement the measure without harming American companies that do business in China and thus use Chinese accounting firms for part of their annual audit. Some critics of the legislation have worried the bill could wind up hurting U.S. companies operating in China. More than 250 companies based in China or Hong Kong are listed on U.S. exchanges, with a combined market capitalization of more than $2 trillion. Kicking Chinese companies off U.S. exchange would lead to huge movements of capital. The legislation could give Washington more leverage in negotiating with Beijing to resolve the standoff over audit inspections, and may ultimately hasten a deal to allow Chinese firms to maintain their U.S. listings. 3 years is a lot of time. There is a good benefit to both sides to have a resolution that both sides can live with. If the bill eventually results in an exodus of Chinese companies, it would deal a blow to the New York Stock Exchange and the Nasdaq, which collect listing fees from Chinese firms and benefit from their trading volumes. Executives from both exchanges have criticized the legislation, saying there are less drastic ways to resolve the dispute. Some larger Chinese companies listed on the NYSE and the Nasdaq have recently floated shares in Hong Kong, giving them a place to go if they are kicked off U.S. exchanges. Alibaba last year established a secondary listing on the Hong Kong Stock Exchange, and its rival JD.com Inc. and online gaming group NetEase Inc. followed suit last year. Other Chinese companies could respond to the threat of a U.S. trading ban by going private. That concerns some investors who worry that management teams could take their companies private at a lower share price, benefiting insiders who would buy out public shareholders. In June, Aberdeen Standard Investments warned that a wave of going private transactions could result in bad deals for investors. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly.